Welcome, everyone, another episode of Financial 15. We have some great information. We're going back to our Becker Orr original series, How to Fund Your Retirement. We're tackling a big question today, commuting your pension. What does that mean? How are the pros? What are the cons? How can that impact your retirement? Kevin, we got lots of information we're going to get to today.
Yes, exactly. That's the biggest factor we're going to do. Again, how to fund your retirement. We've been doing a lot of these series. This is a really important one because a lot of people don't realize it. You may have a pension that's out there. We're going to deal more with the defined pension benefit scenario today. But again, if you want to see more of our videos, please go to our YouTube channel and subscribe. Very important. Lots of great content. Lots of things to take a look at from there. Otherwise, also like us on Facebook and make sure that you visit our website at beckerorr.com because not only do we have the videos there, but we also have lots of blogs, great information for you moving forward. So today we are going to talk, though, about commuting your pension. Clint, what are we dealing with when we're talking about that? People don't seem to have an idea as what commuting it is. What should we start with?
Yeah, commuting, you think, well, am I going to work? Is it traffic? Am I traveling? Different terms of the word, right? Different forms of it. But the idea here is has to do with a specific type of pension, defined benefit pension plan. Now, we've had other videos talking about defined benefit plans. Yep. We won't get through all the nitty gritty here, but essentially the type of pension you're going to pay into it, there's going to be a formula that determines your benefit. Often it's a combination of years of service, maybe your best 5 years of income. There's a formula there. And then you have a guaranteed benefit in retirement. Maybe you'll get, $5,000 a month for the rest of your life, something of that nature. That's the type where the benefit is what's guaranteed, defined benefit plan, as opposed to a defined contribution plan where you put money in, the company puts money in, and all that gets invested, and you have to deal with the outcome. So defined benefit plans, Kevin, you have more options, right, when it comes to retirement, or even if you leave the company, right? Not necessarily retirement. Maybe you work there for 15 years and then you decide you want to work somewhere else. So you're going to have options of how to handle your defined benefit plan. And that's what we're getting into today.
Yeah, exactly. And as you mentioned, we already know what you contribute and we know what the end amount is going to be. So the entire amount in between is made up by the company. By doing that, it allows you different options when you hit that retirement, or if you're leaving the company, whatever the case may be. You're really down to three options, though. A, you can take the commuted value, which we're going to explain as we go forward. And again, we've done videos on this beforehand for what defined benefits are, so you can take a look at there. You can take the monthly income. They're going to give you a guaranteed monthly income for your life to deal with. Or if you are leaving one employer to the other, maybe that new employer will allow you to transfer this plan into their plan or into something that's an existing pension scenario that you can deal with going forward. That's basically the main three options that you have in dealing with how you want to deal with your defined benefit pension.
Yeah, and we're dealing with option number one here. Option number two is pretty straightforward. You retire, you get your whatever amount every month for the rest of your life. Option number one is the commuted value one. So how do they determine that commuted value, right? You're going to get an option that says, yeah, you can get a big lump sum of cash, or you can take this monthly income. Well, how do they determine that big lump sum of cash? There's lots of factors that go into it. Essentially, what they're looking at, there was a present value calculation of all those future benefits. And they're going to look at years of service, average salary, age. You can see the list there. One to note is interest rates, or yields specifically. So if rates are quite low, that commuted value lump sum actually gets a little bigger. And if rates start to rise, you could see that commuted value get a little lower because it is a present value calculation. But big formula, lots goes into it. So your options are going to be lump sum, which is the commuted value, or that regular monthly income, Kevin. And then something to keep in mind here, which unfortunately is always the case when we talk about income and retirement, it comes down to tax.
Yeah, exactly. And that's a big factor as to how it's going to deal with. So we know that if you take a commuted value, that not the entire amount that you have there is sheltered. A portion of it is sheltered in what's known as a locked-in retirement account. And again, the rationale for that is because this is pension money, and they want to make sure that when you hit that retirement phase, you are actually getting money to continue to live on going forward. So it's taxed as income when you make withdrawals. And again, the sheltered amount is determined, as Clint's mentioned beforehand, by a present value factor. So you'll have an idea as to exactly how much is going to be sheltered. But not everything is sheltered. They do that commuted value. Some of it is going to be paid out to you as cash immediately, and it is taxed as income immediately. So you could get a lump sum of $100,000 to say, that is going to be added to your income for that year, and you are going to have to pay the appropriate amount of tax on it. So again, commuted value is not strictly, this is how much I get, and it's all sheltered, and then I can get it from there. There is the formula, as Clint mentioned, and you do have to know what those numbers are before making that determination as to whether I want to commute it or whether I want to take it as monthly income.
Yeah, so if you're making that decision, tax absolutely has to be part of the calculation. And a quick recap here. So we had the three options. So option three was you keep working, you just work for a different company, the pension gets transferred. That's not a taxable event. You're not going to pay the tax till retirement. So Don't have to worry about tax in that case. You take option 2, which was the monthly income. You're only going to be taxed as you receive the income. So if your pension is, say, $4,000 a month, you'd be taxed as you get that income. So each year you'd have to pay the tax on the appropriate income you received. You take option 1, the commuted value, a little more complicated, as Kevin just talked about. That big lump sum of money is going to get divvied up. Some of it will go into that protected lira, so no immediate tax. And then another chunk will be immediately taxed. So often if you take the commuted value, that first year is normally painful because you normally get a pretty big tax bill because that non-sheltered bit all gets taxed at the same time. So you could end up with a wallop of tax in the first year. In fact, that's often the case. So how do they determine that breakdown? A lump sum, some sheltered, some non-sheltered. How do they determine it? Well, the government of Canada has, and you can get this from their website, you dig through the details here, what they call a present value factor. It's pretty simple. It's based on age. They look at your age, they have a factor, and they simply use that to determine the amount that will be sheltered. And we'll go through an example here, but just so you can see, that is the full table. Quick note, as you age and get closer to the retirement age, which the government says is 65, you'll notice that factor goes up, which means you have more that you can shelter, more that you can avoid that immediate tax hit. After 65, that factor declines, which means more and more is going to be taxed up front. So just a quick note there on how you can see that present value factor. But let's move on here, Kevin. Let's quickly look at an example so all this can kind of sink home.
Yeah, exactly. I mean, and let's take an example of Bob, who's 55. I mean, you've got people retiring at 55, 60, 65, whatever the case may be. Of course, the earlier you retire, the commuted value is not going to be as big as if you get closer to that 65 age retirement. But in our example, let's assume that Bob's worked for 35 years of service at the company, and he gets $41,000 per year as a pension. That's what he's going to get if he has it on a monthly basis going forward. So we utilize some of this aspect, and we figure out that he gets an $800,000 commuted value based on where things are. Now, figuring out how much is lira protected and how much is paid out in cash is based on the formula from the previous screen that you've just seen. So based on that 41,000 at 10.4, which was the 55 number, 426,000 plus can be transferred to a lira, which means out of the 800,000 commuted value, 373 is paid out in cash. Now, that is a large lump sum that you're going to have to claim as income for the year, and then you realize how much tax is actually going to have to be paid out on it. So these are factors that you have to take into consideration to decide whether I want the pension or do I want the commuted value. It's not as simple as saying, oh, I get 800 grand, it's all sheltered, and I can deal with it from there. As we see, just a little over half of that is sheltered, and the rest of it's going to be paid out in cash, which means there's going to be a large tax bill that's going to come that year that has to be paid to the government.
Yeah, there would be. In this case, as you mentioned, Bob is 55. The older you are, as I mentioned, you get close to that 65 age, which the government has deemed as the retirement age. The present value factor goes up, so more can be sheltered. Also, usually based on the formula, the longer you work, the older you are, the larger the commuted value. So you could have larger commuted value, you could have more sheltered if you are a little older, closer to that 65. But you have a decision here Bob's got to make. He can take the $41,000 a year, or he can take the commuted value and deal with the breakdown that we've prescribed there. How do you make that decision? You can do all the math. You can say, all right, I got this money. You take away the tax. What do I have left over? And then you can calculate a break even. And there's nothing wrong with doing that. We often do that for clientele. It can get a little more complicated, so we're not going to go through the nuanced math here. What we are going to go through is say, hey, the math is important, but these are big decisions. There's a lot more that comes into play than simply a number. You can't boil it down and say, oh, the math says I should do it, and that's it. It's often a little more complicated than that. So we're going to look at some of those additional factors to may, sway Bob one way or the other. And the first one here, Kevin, taking the pension. What could possibly encourage Bob to take the pension?
Well, yeah, that's a big factor. I mean, these are the biggest parts to analyze. Or what are the pros on one and the cons, and what are the pros on one and the cons on the other side? So we want to take the pension. We know that the pension will pay as long as you live. And for a lot of these pensions, they are indexed. Now, whether they're indexed or not, so let's assume you retire at 55. If you live to 95 or 100, you may have gotten more in income than what your actual pension was because it's paid for life based on what's going on there. Now, the other factor is that a portion of this can continue to your spouse or common law partner going forward. There are abilities to pay for 10 years, 15. There's also abilities to pay for lifetime, depending on what you want to deal with in regards to how much you're going to get. There is no investment decision risk, which is another factor. You are not controlling this. This is controlled by the company. They are the ones that are taking a look at it, or the insurance company where the pension is, and they are the ones dealing to make sure that you get your monthly income every time. And the pension income eligible for income splitting, and early, before 65. So if you retire at 55, you can split that pension income because it is a defined pension plan. Now, cons on the other side, money's not accessible, right? So if you wanted to plan a big trip and take an extra 10 grand out, you can't do that if you're only getting 3 grand a month on a monthly basis. You have to deal with those numbers. Pensions hit hard times too. Now, this is not usually sort of government scenario, but assuming it's a company, if something happens to that company, maybe the entire pension isn't paid up. Maybe it's only 60%. Now you have to worry about, what am I going to get at that time frame, depending on what the pension looks like. And again, there's no estate value. If I take the pension, once me and my spouse pass, if it's, early 5 or 10 years in, there could be a ton of money left that I paid into the pension that is not going to come to my family, because it has to continue in holding from where it is. Yeah. We don't get anything beyond what the value is that we paid.
That's the big one too. That's a big one. The estate value, right? So if you have kids, you want a legacy, grandkids, or maybe you want to leave a big chunk to charity, might not be the option, right? Because you have really no estate value. There are guaranteed periods that you can use when you have a pension, but those options would normally go out 15 years at a maximum.
At the most.
So if you pass away, 20 years later, still not going to help out. And then the pension hit hard times. I'm quickly going to note there that in Canada, most of the defined benefit plans are government.
So
that's not really a big worry in Canada, but there are some privately held defined benefit plans from companies, and that might be a concern if the company hits hard times or the pension hits hard times. Well, let's look at the other side of the coin there. If you decide to take the pension, decide to commute the pension value, well, now the money is accessible. And we just talked about how they're going to pay a big lump of cash right up front. So you definitely have some access to the funds. So if you did want to take a trip, you did want to buy a new car, you didn't just want this regular monthly amount, you wanted to have a little extra here and there, you can definitely do that. You have more flexibility with the cash. You get to decide how the funds are managed. So instead of all of those decisions being done by the company, by the pension team, you're now in control there. You can hire an advisor. You can do it yourself. You have full decision-making capability there. And then the key one I just talked about, any remaining value when you pass away, full estate. So if you have 800 grand and you spend, only 200 and there's 600,000 left over, the full $600,000 can go to your spouse, can go to your kids or grandkids, a charity. You have all the decisions there. You do get a full estate. The other side of the coin, you're taking on those risks when it comes to investment and all the decisions that go with it. If you're not used to volatility, for example, suddenly you have an $800,000 portfolio. If it moves 2%, that's 16 grand. And 2% is a pretty small move when it comes to markets and it comes to investments. Yes. And if you're not used to that, that can be a whole other item, another emotional decision. There can be that large tax hit up front that we had talked about, that unprotected amount, that non-sheltered amount. And unfortunately, in this, once you take the pension, there's no guarantee it'll last a lifetime. No. If you take the income, you do have that guarantee they're going to pay it out for your life. And often there's a survivorship that'll pay it out for the life of your spouse as well. Not the case. You get the lump sum. It's now on you. If you spend it all in 10 years, well, unfortunately, there's not going to be an extra lump sum coming to fill the gap there. So you are taking on that particular risk. And I think this is kind of key here, Kevin, as we're going through all the pros and cons of each option. It really comes down to the individuals. What are the goals? Yes. What are you trying to achieve in your retirement?
Yeah, that's the biggest factor going forward, is what is the goal that you have? I mean, everybody says, well, you can do it one way or the other. There's really no right or wrong answer. It'll depend on what your goals are. One offers you probably more flexibility, but doesn't give you the guarantee, whereas the other one gives you that guarantee to look at and is always something that's worthwhile dealing with. So your goals are the big factors as to what's going on. And of course, when we're talking about goals, Clint, how do we decide what our goals are?
Of course, it has to fit your situation. It has to be part of a plan. If you watched other videos, I think we've said this in almost all the videos.
Yes.
But it is important. It is important. It's going to bring it all together for you to look at the rest of your situation. Maybe you have lots of other assets, so you don't have to worry about the estate because that part's already taken care of. So you can just worry about the guarantee and the pension. Perhaps you don't have a spouse, or maybe you don't have kids, so the idea of an estate isn't as relevant. And there's lots of situations, right? So you have to have a plan that's relevant to your specific situation. What are your goals, your objectives? And then you can use that to determine what would be the best fit. And there's also a personality element here, right? Everyone is a little different. Everyone's going to have different risk tolerances, and you got to make sure it is going to be a fit. If people have additional questions, Kevin, because this is a big topic, where should they go?
they should go to chatwithclintonandkevin.com. We are more than happy to answer any of your questions on the commuting of your value or anything else in our original series on funding your retirement or other questions that you have in the financial matter, or even if there's something you want to talk about in the Jets, we're willing to talk about that as well. Otherwise, this is sort of the end of the video that we have for commuting your pension value. We hope you've enjoyed what's gone on there, and we'll be back with a few more coming soon.
Take care.